Hey everybody, it's Roger Grubb from Mortgage Alliance Main Street Mortgages. Welcome to this episode of Your Mortgage Matters TV. So today I want to talk to you about some of the changes that have been recently announced by the Minister of Finance, the Honorable Jim Flaherty, regarding the changes to government-insured mortgages and how they impact you. There are three changes to the rules that the Minister of Finance announced on the 17th of January and that come into effect on the 18th of March. First major change is that the amortization period has been shortened from 35 years, which is the current maximum, to 30 years. If you're putting down less than 20% of the purchase price on the purchase of a new home and require CMHC, Genworth, or Canada Guarantee insurance, the maximum length of time that you can stretch out your mortgage payments will be 30 years as opposed to 35 years. It's going to cost you a little bit more in terms of your monthly payments with a shorter amortization, but at the same time, it also is going to cost you less in terms of interest. It also means that the maximum purchase price that you'll be eligible to qualify for a mortgage may be less. So that's something that you would have to work with your broker or your mortgage agent, your mortgage professional to determine how best you qualify and how best these rules impact you. But the next major change that the Minister of Finance announced concerns the maximum amount of equity that an existing homeowner can withdraw from their home. In the past, homeowners were able to use CMHC insurance or one of the other insurers to withdraw up to 90% of the value of the property for whatever purpose they desired. So it could be for renovation, for debt consolidation, or for investments. Now that number has actually been limited to 85%. The last rule change that the Minister of Finance announced was in regards to the government withdrawal of backing for line of credits and HELOC type products. This doesn't really impact Canadians that much simply because most financial institutions require you to have a minimum 20% equity in the home in order for you to obtain these products to begin with. Most of them were not insured. There are a few lenders that actually started utilizing the insured program to offer these products to Canadians, but as far as them being widely accepted or being used by a lot of Canadians, I don't think that they were that widespread, so it shouldn't impact the Canadian marketplace as much. If you're putting down more than 20% on the purchase of your home, these rule changes won't really impact you. First of all, you're still going to be able to get a 35-year amortization. You can still refinance those mortgages as long as you're not increasing the mortgage amount or increasing the amortization period. The line of credit situation, again, that doesn't really impact you, so that will be status quo from here on in. There you have it, the rule changes in a nutshell. If you need more information about how these new rule changes impact your unique situation, please feel free to give me a call or contact a member of the Mortgage Alliance Main Street Mortgages team at www.mainstreetmortgages.ca. Until next time, thanks for tuning in to Your Mortgage Matters TV.